The European Central Bank has unveiled a set of new stimulus measures to try and boost Europe's sluggish economy. This comes as the Federal Reserve is set to take the opposite approach, and it's causing some real confusion in global markets. Sohn Jung has more.
The European Central Bank has decided to cut its deposit interest rate further into negative territory to minus 0.3% from its existing minus 0.2%. The move is aimed to boost lending by charging banks more for parking cash with the central bank. ECB President Mario Draghi announced further measures at a news conference on Thursday. He said its monthly €60 billion stimulus program would also be extended by at least 6 months to March 2017.
Today's decisions also reinforce the momentum of the euro area's economic recovery and strengthen its resilience against recent global economic shocks.
The Eurozone is facing tough economic conditions, including generally sluggish growth, the risk of deflation, and worries about the impact of the terror attacks in Paris on business and consumer confidence. The scale of the new measures fell short of investors' expectations, who anticipated a bolder deposit rate cut and an increase in asset buys. European stocks sank Thursday, logging their worst session in more than 3 months. Now the focus has shifted to the U.S. Central Bank, which is expected to drive rates in the opposite direction this month. The Federal Reserve looks set to raise rates for the first time in 9 years, following the latest upbeat assessment of the U.S. economy's progress. As the two biggest economies take a different policy approach, uncertainties and volatility are expected to linger on international markets for the time being. Sohn Jung, Arirang News.